Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Broadcom, AVGO. We're going to focus squarely on their explosive growth and this rapid transition they're making. It seems like they're becoming the primary hardware supplier for what their own management is calling the AI monetization supercycle. We've been sifting through all their recent financial reports, the executive commentary, just to get a handle on this massive shift.
It's a fascinating story. Broadcom is positioning itself as you could say, the silent winner of the AI era by really dominating the custom silicon market, the XPU market for the big hyperscalers. And this dominance is what's justifying a massive revenue ramp. We're talking projected to exceed $40 billion in 2026, even as the company experiences this, noticeable margin dilution from shifting its sales from just chips to full system racks.
Okay, let's unpack this because that's a really interesting conflict right at the heart of the thesis. A silent winner with massive revenue growth, but at the same time, they're accepting pressure on their gross margins, which have been historically so strong. That needs a closer look. So to start, who exactly is driving this enormous demand? Because it's clearly not the traditional tech market.
It absolutely is not. And Broadcom CEO Hock Tan has been explicitly clear about this. Their strategy is highly concentrated. They've chosen to serve what they call a narrow group of about 7 key customers.
Just 7.
Just 7. They define them as the most powerful LLM creators in the world.
So these are the big hyperscalers. We're talking Google, Meta, that kind of player.
Exactly. Your Googles, your Metas, maybe an Amazon, plus a handful of those leading super startups that are really defining the next AI platforms. They are not interested in the thousands of other companies down the chain.
That feels like a really high-stakes bet. If you focus all your energy, all your R&D on just 7 massive customers, doesn't that give them immense leverage over you on pricing? I mean, why is this handful of players the only market that seems to matter to them right now?
It's a trade-off, definitely. But it's driven by scale and, frankly, technological necessity. These 7 players are the only ones who need custom silicon, these XPUs, at this scale, mainly for the inference phase of AI.
Right. So just to clarify for everyone, AI has 2 parts. You have training, which is super expensive and compute heavy. That's building the brain.
That's NVIDIA's kingdom, traditionally.
And then you have inference, which is the daily usage, actually running the model millions of times a day to answer questions, make images, whatever it is.
Precisely. And once that model is trained, the game changes completely. It's no longer about raw speed at all costs. It's about optimizing for cost efficiency at a massive, massive scale. When you are running billions of these interactions every day, the cost of that compute becomes your single biggest operational expense.
And that's where Broadcom's custom silicon comes in. It gives them a huge cost advantage over just buying off-the-shelf GPUs.
A critical, unassailable advantage, yes.
So give us the hard numbers. How big is that advantage?
It's significant. Analysts estimate that Broadcom's custom silicon, like the Google Ironwood TPU they helped design, is coming in at around, say, $13,000 a chip.
Okay, $13,000.
Now, you contrast that with a leading NVIDIA merchant GPU, which can easily cost you $30,000, maybe $40,000 per chip.
Wow, so you're looking at a $20,000 plus difference per chip.
Per chip. And if you're a hyperscaler deploying millions of these things to handle global traffic, that cost differential is just staggering. It lets them fundamentally undercut the pricing of any competitor who's just using merchant silicon.
That is the core economic engine right there. And the market is validating this in real time. We've seen Broadcom secure a confirmed $10 billion order from customer 4, who everyone pretty much believes is Anthropic.
$10 billion specifically for these XPU racks.
Right. And then, just last quarter, they announced another one, a new $1 billion initial order from a 5th customer for delivery out in late 2026.
And that visibility is just phenomenal. It gives you incredible confidence in those 2026 numbers.
So these aren't just speculative projects. These are locked-in, multi-year commitments.
Absolutely. But while the custom XPU is, the star of the show, the real technological moat that Broadcom is building doesn't just rest on the chip. It's in the infrastructure around it, the network.
That's a crucial pivot, because at this scale, the processor itself isn't the main bottleneck anymore. It's moving the data between all those chips. As the CEO said, and it's a great quote, at this scale, the network becomes the computer.
Exactly right. When you have thousands of these XPUs all trying to talk to each other to do one complex task, how fast you can share data becomes the limiting factor. So Broadcom is creating this defensive position by controlling the interconnects. And their strategy hinges on this massive bet.
The bet on Ethernet.
Yes. That open standard Ethernet, which they dominate, is going to displace the proprietary closed ecosystems like InfiniBand that some of their competitors favor.
And why would a hyperscaler choose open standard Ethernet? What's the advantage there?
It's flexibility. It's the difference between being locked into one vendor's entire system versus having an open standard where you can mix and match components for better price and performance over time.
And that bet is paying off.
It is. It's being driven by just unprecedented demand for their high-end switches. Specifically, we're talking about the 102.4 terabits per second Tomahawk 6 switch.
102 terabits per second. That's just an incredible number. Why is that specific speed so critical right now?
It's the linchpin. At this kind of scale, the difference between 50 terabits and 100 terabits is the difference between a cluster that works and one that just stalls out because it's starved for data. The Tomahawk 6 is the market leader, and it's essential for linking up all those powerful custom XPUs, making sure the network can keep pace with the chips.
And this really highlights why they're so focused on the network inside the data center. Management says the scale-up opportunity connecting chips within a rack or a cluster is 5 to 10 times larger in terms of revenue than the old scale-up model of just connecting racks to each other.
That's a great way to put it. Think of it like this. The old networking market was building the highways between cities. That's scale-out. Broadcom is now focused on building the central nervous system inside the brain itself. That's scale-up. The guts of the AI system are where the multi-billion-dollar opportunity is now.
And that shift connects directly to the massive financial catalyst we're seeing. The AI components alone, the XPUs, the switches, the optical parts are driving almost all of this incredible growth.
The acceleration is just stunning. Their AI revenue grew 65% year over year. It just hit $20 billion in fiscal 2025. This wasn't just incremental growth, it was a fundamental shift.
And the projections suggest it's actually getting faster. The expectation now is that AI revenue will double from there. It's going to accelerate past that 65% rate to hit over $40 billion in fiscal 2026. What gives the market so much confidence in such a huge number?
Visibility. It all comes back to visibility. They aren't just guessing. They're delivering on signed contracts. Right now, Broadcom is sitting on a massive $73 billion AI backlog. That's XPUs, switches, all of it. And it's all expected to be delivered over the next 18 months.
So that gives them this ironclad line of sight into their 2026 revenue, which is crucial when your valuation is this high.
Exactly.
And this all ties back to the long-term vision. We know CEO Hock Tan's compensation is explicitly linked to hitting a target of $120 billion in AI revenue by 2030.
Which is a public declaration. It signals a six-fold growth expectation over the next 5 years.
An incredible target. Which brings us back to that core conflict we mentioned at the start. You have this explosive revenue, but this margin pressure. If the demand is so intense, why is the gross margin percentage actually going down?
Right. It's that shift in the business model. It all comes down to their decision to move towards system sales. They're not just selling the high-margin silicon chip anymore.
They're selling the whole rack.
They're selling the whole rack.
Yeah.
And it's really just a mathematical reality, not a sign of bad execution. They're acting as a systems integrator. So the gross margins get diluted because when they sell that full rack, they have to pass through the cost of these incredibly expensive components they don't make. The biggest one is high bandwidth memory, HBM.
So it's like they make the world's best, highest margin engine, but now they're selling the whole custom car, and they have to buy the tires and the chassis from other vendors. The margin percentage on the whole car is lower than just the engine, but the total dollar profit is much, much higher.
That's a perfect analogy. The percentage shrinks, but the sheer volume of revenue means the dollar profit grows substantially. It's a trade-off to capture the entire system's value.
And the counter-argument to the margin concern is the incredible operating leverage they're getting.
That's the key. While gross margins dip, their operating expenses are growing much, much slower than that revenue ramp.
So every new dollar of revenue, a huge chunk of it is falling straight to the bottom line. It's driving massive cash flow. We saw that in the Q4 2025 results, didn't we?
Yeah, we did. The semiconductor operating margin actually rose 250 basis points year over year. The leverage is clearly working. And that cash flow is phenomenal.
What are the numbers?
Q4 2025 free cash flow was $7.5 billion. That's 41% of revenue. They are managing costs with incredible discipline while revenue just explodes.
So if we synthesize the whole investment case, Broadcom's position is undeniably powerful. They are the indispensable partner for the biggest LLM creators. They provide the cost-efficient hardware needed for monetization, for inference. The central question for the future, then, is can they maintain this position? Can they flawlessly execute on these incredibly complex custom silicon roadmaps?
And execution is where the big structural risks live. First, we just have to acknowledge the valuation. It's high. It already reflects these extremely strong growth expectations, including that 100% year-over-year AI revenue growth that's expected in Q1 of fiscal 26.
So any misstep, any delay, is going to get punished severely by the market.
Without a doubt.
What are the biggest specific technological hurdles in this custom ASIC market that could derail that execution?
It's the supply chain. The primary risk is the severe supply chain constraint and just the complexity of the tech. We are talking about securing massive capacity for bleeding-edge silicon 2 nanometer, 3 nanometer nodes. And then there's the incredibly complex advanced packaging you need for these multi-die XPUs. The CEO himself has cited 18-month lead times for some of these critical components.
18 months, that's a huge risk window.
It's a technology race. They have to execute perfectly, on time, for 7 of the world's most sophisticated and demanding customers. They are mitigating this, of course, by building their own advanced packaging facility in Singapore, but that volatility is real.
So the stock really represents a high-risk bet on not just success, but flawless execution. Because those powerful customers are always looking for a better deal, a better cost-performance ratio. They'll jump ship if Broadcom stumbles. Which leaves us with a final thought for you to consider, thinking about that long-term target of $120 billion in AI revenue by 2030. How much of the $73 billion in backlog they have right now is truly recurring, durable business, and how much is just pent-up demand being pulled forward in this explosive initial phase of the AI monetization supercycle? Risk defined, portfolio protected.